Hey guys, Toby Mathis here with Anderson Business Advisors. Hey, a question I get quite often is what to do when I sell my house to make sure that I pay no tax. And that one's pretty easy. There's something called a 121 exclusion, which most people know that you have to have lived in the house 24 of the previous 60 months prior to selling it, and you have to pass the ownership test. You have to own it when you sell it. And so in English, it means that if I lived in the house as one of my primary residence or my personal residence, and I had 24 months during that period of time and it qualifies, then I could qualify for, as a single person, a $250,000 exclusion against the gain, the capital gains, not depreciation recapture. That's important. Against the gain on the home, or if I'm mailing or married filing jointly, it's $500,000. So that's a big, huge capital gains exclusion that you definitely want to capture. Now, here's what sometimes happens. Somebody purchases a house, the real estate market runs up over the years, maybe they've been in it for 15 years, 20 years, and they want to sell it and go move someplace else. And they say, hey, how do I avoid the gain? Sometimes they'll have a twist. They say, what if I want to keep it and I want to make it into a rental? Then do I just put it into a rental? And most of the time, practitioners are going to say yes. And they just left a ton of money on the counter there, and they passed up the chance to use their 121 exclusion. Here's why. That 24 of 60 month rule applies to before you sell it. You have to be the owner and you had to have lived in it for 24 months out of 60. But if you were renting it too long, you will lose that deduction entirely. In other words, you get past 3 years, it's gone. So if you're going to keep it and you're going to make it into a rental, it does not make sense to not use the 121 exclusion. And then you're going to say, well, you can't use it. Who do I sell it to? I'm not going to sell it to somebody else. How do I get to make it a rental property and be selling it to somebody else? I mean, how do I keep control of that, Toby? Well, you have to think outside the box. You can sell it to another taxpayer. My business partner, Clint Coons, has done videos on this and has done a really good job of explaining how it works and the concept. I'm just going to put a little more meat on the bones here. All we're doing is we're literally taking you. So let's say that I have a client as a person. You have a 1040. You're the one who gets the 121 exclusion, and we're going to sell it to another taxable entity. The most obvious entity that is going to be the best for the tax treatment on a rental property is actually going to be an S Corp. And so we will make this into an S Corp. And when I say S Corp, that means for federal tax purposes. So it could be an LLC taxed as an S Corp or a traditional corporation that makes an S election. And all we're doing is selling it at whatever the fair market value is. It needs to be fair market value, something reasonable, and now you will capture the 121 exclusion. More importantly, so let's just use numbers. Let's just say that I bought my house. Let's just say it's $100,000. I bought it for $100,000, and now it's worth $600,000. I bought it, let's say it's me and my wife, and we bought it, and we're looking at a potential gain of $500,000. And you say, hey, I don't really want to sell it, but I would like to not pay tax on that $500,000 ever. You do the sale at $600,000. The S Corp agrees to pay you. Now, a lot of you guys are going to say, well, wait a second, where's the S Corp going to get the money? You need to have about 10 to 20% of the cash to make it a bona fide sale, to make sure it's reasonable. So you're going to want to make sure that you fund the entity with something. But the S Corp can pay you over time under an installment sale. In other words, it doesn't have to come up with all the cash now. Maybe it comes up with $60,000 down. What this will do is give you a new basis here of $600,000. If you know how to do depreciation, then you're going to take the land value and you're going to subtract that from this 600,000. So 600,000, and you're going to get X number of dollars to depreciate over 27.5 years. So what's going to happen is you're going to get a large amount of depreciation as a result. You're also going to have a new basis of $600,000, which means if in 10 years I decide to sell it and it's gone up to 700,000, let's say, then my only gain is the 100,000. I literally am going to get to keep the $500,000 off the books as far as taxation. No tax on that, the $500,000 a gain, because I chose to do this. If I rent it, and ordinarily if it was just me and I turn this convert it into a rental, my basis is $100,000. That's what I'm using for my depreciation. Not $100,000, I have to subtract off the land value. But I would only get to depreciate a small amount. So I lose all that benefit. It means that I pay tax on all of the rents. So in English, I pay a lot more in tax. Plus, I just screwed up and I didn't get my $500,000 capital gains exclusion. So let me just go over how this works. You have to form the S Corp. You have to make sure that when you're selling it, that you use an installment sale. And most importantly, you're using an installment sale, but the entity is actually going to elect out of treating it as an installment sale. So the entity immediately says, I am buying this for $600,000. Even though I'm paying it over time, I'm treating it as though I bought it for $600,000. All that means for you is you're recognizing all of that income. Even though you haven't been paid the money yet, I'm recognizing all of the income in the year that I sold it, because I want to use up that $500,000 big, huge, fat exclusion. These are just tax elections so that the IRS believes that I paid or was paid the $600,000. In other words, hey, I know it hasn't paid yet. I know it's going to be paying over time, and it's paying over the time. How is it paying me, by the way? It's paying with the rents. Rents come in. It's paying me on the note. Yay! I'm going to get the cash. Now, the sale has to be a bona fide sale. This is a big one. It has to be for fair market value. So I'd actually get an appraisal. I would literally go get an appraisal on it, and I would probably use whatever amount's going to give me the most bang for my buck. I'm going to want to get as much of that $500,000 over, as I can. So this number may be different. Maybe that's $500,000 that I'm selling it for, and I'm only using $400,000 of it. I just want to use up my 121 exclusion. I don't want to leave it on the table. And that 121 is on the year that I sell it. That's me personally. I don't have to recognize the gain when I do that. And I hope that is starting to sink in. That we're literally taking something that we would have lost all of that exclusion. And that exclusion is worth quite a bit. That could be $150,000 worth of exclusion, depending on where you live. Your capital gains rate, plus your state, plus your net investment income tax, all these things start adding up. And the next thing you know, you're looking at a 33% tax on $500,000. That's over $150,000 that you gave up of tax savings, not of deduction, of tax savings, like dollars you would have paid. You quite literally, just by doing this, you save yourself $150,000. Now, one red flag, big red flag. Once that property is in that S Corp, if you ever take it out and give it to yourself, that is going to be treated as ordinary income. It's going to be treated just like the company paid you. So you don't want to do that. You want to make sure that you have a good tax advisor to keep you from making mistakes. But the rents still flow down as rents. You have depreciation offsetting them. There's a very good chance you're not going to be paying any tax, depending on the numbers. But if you have enough depreciation, there's a good chance you're not going to have much of a tax bill on the rents that you're receiving all those years. That's coming back into you. So it's a fantastic situation. The only other thing you should be aware of is you may be recognizing some interest on that note, but it's peanuts in comparison to the amount that you're going to capture and you're going to grab as the exclusion. Very, very powerful technique, oftentimes misunderstood. Most practitioners can't get their mind around it, so they immediately say No, there's no other option. There's always an option. And the thing you want to get in your head is how. Always be asking, how can I defer a tax? How can I avoid paying tax? It's absolutely legal to avoid taxes. But the biggest thing is always starting off with, is there a way and how do I accomplish it? You want to be asking folks like myself and my group and Anderson Business Advisor and my partners, are there ways to get around this? And if somebody's immediate reaction is no, there's no way, pass on them and go to the next one to see if somebody can actually dig into it. There's usually some creative ways to push things off into the future or capture something that you're entitled to. Like here, this big, huge, fat exclusion, we don't want to leave it on the counter. We don't want to leave it on the table for somebody else. Like we just pass it up. No, we want to capture that. We want to have our cake and eat it too. We want to have the step up so that we get higher depreciation, and we want to capture our big, fat, huge capital gains exclusion.